Investing advice from Warren Buffett. A little background information on Warren Buffett. Warren Buffett is one of the most successful investors globally. He also leads a billion-dollar empire, Berkshire Hathaway, as its chairman and CEO. Today, his investment principles and wealth of experience continue to inspire and provide investors with valuable insight. Join us as we delve into his portfolio holdings and the famed principles that have sculpted him into the legendary investor he is today. Hello and welcome to What is the Matter, where we discuss money matters. Today we will be seeing what one of the wisest men in the world has to say about investments and go through his golden words. Let's first talk about Warren Buffett's top portfolio holdings. The top spot goes to Apple, accounting for 50.04% of Buffett's portfolio. According to Buffett, Apple checks all his investment criteria, having robust business fundamentals, loyal brand following, high-quality management, consistent cash generation, and commitment to shareholder returns. Apple's straightforward business model also resonates with Buffett's investment preferences. In second place is Bank of America, comprising 9.03% of his holdings. Buffett recognizes the critical role banks play in providing systems and infrastructure for individuals and businesses to deposit and borrow money from. His affinity for Bank of America stems from its consistent dividend payouts, solid financials, diversified business model, and strong management team. Although Bank of America's stock price has experienced a 20% year-to-date decline, and is approximately 25% below its prior peak due to the banking crisis in early 2023 and concerns about a looming recession amid a high-interest rate environment in the United States, Buffett has remained optimistic about the company's ability to weather short-term challenges and deliver long-term value to shareholders. This is why he continued to invest in Bank of America stocks, as he viewed them as undervalued. Coming in third place is American Express. Buffett holds a substantial stake in American Express, amounting to 20.08% of the company's shares. Buffett has always appreciated American Express's brand strength, customer loyalty, and business model, with consistently strong financial performance, as well as a track record of enhancing shareholder value and liquidity through various share buybacks and splits. Additionally, American Express has showcased resilience, navigating through economic challenges and emerging even stronger over the years. Fourth place goes to Coca-Cola, one of Buffett's most favorite companies. He has often referred to Coca-Cola as a forever stock due to their global brand recognition, sustained market dominance, significant competitive advantage over rivals, and extensive track record of success. Coca-Cola has also earned the title of Dividend King for its consistent and rising dividend distributions to investors. Finally, in fifth place, Chevron. Chevron's major role in the oil sector allows Buffett to capitalize on sustained global energy demand. Chevron's strong financial standing, integrated operational structure, and diversified portfolio offer a degree of protection against oil price volatility and inflation. Now let's get to the part that you're waiting for, the pearls of wisdom from Warren Buffett's investment advice. Rule number 1, never lose money. Rule number 2, don't forget. Rule number 1, perhaps Buffett's best financial advice of all, it serves to remind investors that when making investments, they should always prioritize mitigating risks and not be willing to accept capital losses. Buffett only invests in companies he comprehensively understands and analyzes. That is why it is so important for you to always conduct your due diligence to make informed investment decisions. Otherwise, it just becomes gambling. If you own your stocks as an investment, just like you'd own an apartment, house, or a farm, look at them as a business. Buffett stresses the significance of not buying stocks, but rather buying companies. He advises investors to assess a company's long-term potential by evaluating factors such as its core operations, business fundamentals, competitive advantages, management competence, and ability to sustain profits and shareholder returns. When investing, Buffett always sticks to what he understands and believes about the intrinsic value of the company, rather than being swayed by the market. He trusts his intuition that high-quality businesses will thrive in the long term, thereby benefiting their stock value. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Buffett is one of the world's best value investors as he prioritizes acquiring high-quality but undervalued businesses, enjoying superior long-term outcomes in terms of returns, capital growth, and shareholder benefits. He stays committed to choosing excellent companies rather than being tempted by cheap deals on mediocre companies. What we can learn from this approach is to set our own standards to select top-tier companies at favorable prices to get the most value out of our money. A simple rule dictates my buying: be fearful when others are greedy, and be greedy when others are fearful. Buffett always stays rational and calm when investing, emphasizing fundamentals over blindly following market sentiment. Amid market exuberance, he cautions against speculative buying, encouraging investors to exercise prudence. During market downturns, he encourages seizing discounted opportunities. To achieve long-term success in the market, we need to be patient, disciplined, and confident in our strategy. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Buffett embraces investing in stocks that he will hold forever. He overlooks short-term market fluctuations and is confident in the company's long-term potential for success. He discourages speculative trading or short-sighted strategies, choosing to always focus on the long term. This is why he decided to maintain his portfolio during the financial crisis, despite facing substantial losses amounting to $25 billion. I make plenty of mistakes, and I'll make plenty more mistakes too. That's part of the game. You just have to make sure that the right things overcome the wrong. Finally, no one is perfect. Even the great Warren Buffett makes mistakes. For example, his miscalculation regarding Dexter Shoes' management capabilities and failure to anticipate the impact of shifting production costs and international competition resulted in their investment in Dexter Shoe losing nearly all its value. What makes an investor like Buffett different is how he learns from his mistakes. That mistake allowed Buffett to reflect and be more cautious, to thoroughly understand a company's competitive landscape before investing, and be mindful not to overestimate management's abilities. It's never wrong to make mistakes, but it's wrong if we don't humble ourselves and seek to learn from it to be better investors. If you want to be as humble as Mr. What is the matter, consider subscribing to my channel now, as I will be sharing more contents like this. See you very soon.